have heard about or are thinking of making an S-Corp election for your business or side hustle. It can be a really smart, savvy move to save thousands of taxes. But before you make a move like that, there are some important things you should consider. Hi, this is Adam, your ad advisor, here to share legal and tax strategies used by the rich to help the rest of us catch up. Let's break it down. First, what is an S Corp? An S Corp is not really a type of business structure, it's more of a tax designation. Your business set up as an LLC or as a corp can make an S Corp election so that for tax treatment, it's a pass through, but it's still recognized as a separate entity. When you elect S Corp status, you're telling the IRS to treat your business as a separate pass through entity, separate from a solo practitioner, separate from an LLC, disregarded entity, separate from you yourself, the owner. It's a completely separate entity for tax purposes. So that means it'll file its own tax return in addition to your personal one. And it's this separate tax entity structure that unlocks two key advantages that we're going to go over today. That is salary splitting and accountable plans. So with salary splitting, when you make an S Corp designation, the IRS requires that you, the owner, need to pay yourself a reasonable salary. It means you put yourself on payroll that reflects the fair market value compensation of the work you, the employee, you are giving to the business. The salary is subject to payroll taxes like Social Security and Medicaid. But the benefit here is whatever you don't pay yourself in salary, the rest of it, that's just the profits of the S Corp, the profits of the business. None of that is subject to any payroll tax. None of that is subject to any unemployment tax. So the profit that you'd otherwise be getting from your sole proprietorship or your LLC, that would all be subject to unemployment tax. Damn. The rest of your business profit, though, is flows through you just as taxed in your income. But the trick, the salary split here is that the rest of the salary is not subject to any payroll taxes, not. But here's the trick: the rest of the business profits, that's not the salary, the rest of that goes onto your 1040. But here's the trick: the rest of those profits, the rest of that flow through that is not part of your payroll taxes only gets taxed at your income 1040 level. It's not subject to payroll taxes. It's not subject to the 15% unemployment tax. So this is your savings here. And the second advantage is accountable plans. Accountable plans is how your business reimburses you, the owner, for expenses that you've made in your connection with the business. So yes, this covers things like, it can cover things like laptops, cell phone bill, car expenses, which you might be realizing you can already take these on your Schedule C as a sole proprietor. And the second advantage, accountable plans. Accountable plans are how the S Corp, your business, reimburses you, the owner, for expenses you made in connection with the business. So this covers ordinary expenses that you would otherwise get in your sole proprietorship, like a cell phone bill or car expenses or meals. The benefit here, though, is that it also unlocks the home office deduction and the Augusta rule. So you may have already third of a home office deduction. For a sole proprietor, it's actually really limited. It's like something like 3% of gross income, and it's like limited like 1,500, which probably isn't a great representation of your rent expense. But if you can do it through an accountable plan, you can take whatever portion of your living area is your home office of your entire residence. You could take that percent, 25%, 50%, and say all expenses associated with that you can reimburse yourself for. So if you're living in California and you have 1,500 in rent, in a third of your place is your home office, that's a $500 month deduction. It's really powerful. And Augusta, we can go over, but that's also going to unlock some crazy savings. Now, the downside here, or things to consider, is the administrative cost with this. As I said in the beginning, the S-Corp comes with it requiring its own tax filings. That's for federal and generally for state too. So for federal, it's the 1120S. If you're in California like myself, that's another 100S filing. And also, as you're paying yourself a salary, probably going to need some type of platform to cover that salary, the payroll taxes, all that. It's a huge headache. So things like QuickBooks, yeah. So the expenses are probably going to be at least $1,000 on the year, maybe two, maybe more, and just the administrative timing with it. So that's why I say really it's only if you're making like 50 to 100K would I really consider making this S-Corp election a smart move. But once you get past that threshold, definitely want to take advantage. Cool. Thanks for joining this video. Again, I'm Adam, your ad advisor, and please just keep in mind that this is for educational purposes only. Before you make a decision like this, consult your own CPA or lawyer. Peace.